This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Matt Miller, Paul Sweeney, sitting in for Massar and Tim Stenovec here at Bloomberg Businessweek. And it is time for Plugged In on Bloomberg Businessweek, your weekly look at EVs. Daniel Barel, he's the CEO of Automotive. It trades on NASDAQ, REE. He joins us, I believe, from Israel. Daniel, thank you so much for joining us here. Tell us about what you folks are doing at Automotive. What's your play here in the EV space?
Thanks for having me, of course. So we're an OEM with a very unique technology of by-wire electric trucks. We're focusing the mid-size commercial segment. We have a unique technology that allows us to incorporate, state-of-the-art technology in terms of downtime, maneuverability, and of course, total cost of ownership in a way that have yet been to the market. That's basically it.
So what does the vehicle look like? Who's going to buy it? And is it cool?
Oh, yes, it is cool. Commercial trucks up until quite recently have not been that cool, I think. But I think
in my head, I get a picture of a white van. And I feel like there's almost nothing worse than a white van on the road.
That's a fair point. But speaking for the white vans out there, they do have better thermal resistance to sun, right? And that point. But basically, we sell trucks to fleets in the U.S., a very large and growing segment of the market where a lot of the corporation and fleets in the U.S. have pledged significant targets for carbon neutrality and electrification in the past few years. And I think now is the time that we see that coming into fruition.
So at this point of your evolution here, young company, I mean, who's a typical customer for you as you think about growing your business?
Well, first of all, more than 70% of the trucks in classes 3 to 5 in the U.S., mid-size, are actually sold through dealers in the U.S. So we have a network of dealers in the U.S., a very bespoke network of dealers that cover the whole U.S. and parts of Canada. We have 16 dealers that we've announced recently and 3 fleets. Those dealers serve basically most of the fleets you see in the U.S. And we sell through those dealers to the fleets.
And I guess you've got batteries that are powering these. Are they your own batteries? Do you buy them from another company? How's that work?
Yeah, so our motto is that we complete, we don't compete. And this is why we have been around for the past 10 years. The crown jewel, if you like, of our technology is what we call the corner. So everything that makes the car go, the motor, the steering, the braking, all those are packed in the corners of the vehicle, essentially around the wheel. And we take 4 of those and we put them basically anywhere you want in space and build a truck around them. So we can have a very flat and very, very modular chassis to build upon. And we use, we are power agnostic, although we're using batteries by Microvast, which have great technology.
What do you mean power agnostic? You mean you could use other kinds of drivetrains as well?
Yes, we can. Yes, we can use batteries, we can use fuel cells, we can use different types of batteries. I think when you bring new technology to the market, you want to make sure that you have as little limitation as possible going forward, right? So as you scale up and as technology moves forward, you want to be able to be agnostic to many constraints that currently are in the market.
Hey, Daniel, we've recently heard from a lot of the legacy automakers that maybe the demand, ultimate demand for EVs, at least for right now, is maybe a little bit less than they had anticipated. Are commercial EV companies seeing the same trend?
Actually, no. We are actually seeing a much stronger demand and a growing demand in the commercial segment. I think for three main reasons. One is that the commercial segment, especially the mid duty segment, has not been electrified in scale yet. So there's not been saturation at all, almost, because there's been a lack in demand or product readiness, if you'd like. And we see a very strong, demand from the market. We recently doubled our order book value just in 2 months. And second, we see that the charging infrastructure and availability of power has significantly improved in the US. That allows to deploy more and more commercial trucks, right? Because if you think about it, a commercial truck usually would not be queuing in a, public charging station waiting,
right,
in line to queue. So you have to look at the bottleneck of also charging infrastructure and maintenance, which are all quite advancing now in that segment in the US.
So it's a very different market, essentially, than
Yes.
the personal vehicle market. And what kind of growth are you seeing, like at your company and in the industry?
We see a very strong demand from large fleets, and
can you quantify it?
Yes, of course. So you should look at it, in a way that we take very close, relationship with those fleets. We look at them as design partners. We are more of a tech company in automotive than traditional OEM. So it's in the adaptation of EVs, the fleets have made a very strong voice of the customer as to what is it that they want in a commercial vehicle. And once you're able to address that and provide them with a truck that they want to buy, then the adaptation becomes very strong, meaning they will usually start with a few tens or hundreds of trucks, and then they will multiply it to the lower hundreds and thousands of vehicles. Now, just to put things in perspective, just, class 3 to 5 in the US, you're talking about numbers are different than passenger vehicle in that aspect. You're talking about 1.5 million units a year in the whole US for the whole segment, right? So a scale up of a few thousand or a few tens of thousands is massive.
I'm just seeing that your order book has doubled to $40 million, if my numbers are correct. Do you expect to be able to continue on that trajectory? It seems fast.
First of all, thank you. Yes. It is, listen, it is very, very easy to lose money in the automotive business, especially when, you're ramping up and building a field of dreams. And as we've all seen, many companies go bankrupt, right? Trying to cross the production hell desert. What we're doing is that we've built a very modular capacity that allows us to increase our capacity as we grow our order book. And we're building to order. We're not building for inventory. So we see a strong demand. We're able to meet that demand, but it's also very important to scale up responsibly, right? To avoid unnecessary recalls or inadequate product launches.
So I just have to ask you, Danielle, how is the events that are happening in Israel over the past month, how are they impacting your company?
The war is affecting us all, right? Especially those that are in Israel. And some of our employees have been called to service. And those that have not are supporting our teams and fellow countrymen, of course. I think that in these times, it's my responsibility to steady the ship, even in choppy waters. And we're committed to deliver no matter what. By the way, not only for our shareholders, but also for ourselves. And as believed, the rest of the Israeli tech company communities. And I think specifically for RE, we're built in a way that most of our employees are actually outside of Israel. Our production mainly is in England and the US.
Okay.
Yeah.
All right, Danielle, thanks very much for taking the time. I really appreciate it. Danielle Barel, he is CEO of RE Automotive.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Chris Heller joins us. He's co-founder of Cordillera Investment Partners. Chris, thanks so much for joining us in studio here. We appreciate that. How do you focus on the alternative space at your firm?
Yeah, great question. Thanks for having me. I really appreciate it, guys. So at Cordillera, I think of us as alternative. So certainly the alternative space has been around for quite some time, private equity, real estate, natural resources, et cetera. And we really view what we do at Cordillera as going back to the basics of finding alternatives 20 years ago, right? Those asset classes were alternative in the late 80s, early 90s, but now there's a lot of capital that has flowed into those spaces. So we are about finding the next new thing. So the original promise of alternative investments, which is be early to an asset or an idea. And by being early to that, you can extract outsized returns. And then secondly, non-correlation. So finding things that zig when other things zag. So the assets that we invest in, the companies that we invest in should have cash flow streams that do something totally different. If you told me what the S&P 500 did today, it will say nothing about what the things that we invest in.
Can hedge funds still do that? Do hedge funds hedge?
Great question. The good ones do. The good ones do, and they get paid for it. And I think the one of the issues with that asset class is there's a lot of people out there with sort of long-only equity beta that are charging fees that they probably shouldn't. 2 and 20 is expensive to get long-only equity beta.
And they're in a herd, right? They're all doing the same thing
correct.
all the time.
I mean, that's really why we do what we do, mainly because we're not smart enough to compete with the entire herd, right? We took a step back and said, look, if we can go where nobody else is, we're kind of smart enough to compete against people where there's nothing there. I don't know how every day you can walk into the office and try to outsmart the entire world who's trying to pick stocks. It's tough.
That's what I meant. That's why I left the hedge fund business in '96. I said that long short equity game, done. Can't do it. And I thought I had the coolest idea. I went to the meeting and there were like 20 guys, all of whom I knew there in the room. So it wasn't so good.
Dude, you should have gotten into private credit.
Private
Credit is what I meant to say. So let's put to Chris, because you said it's going to explode, and I know why you said that.
I'm a little concerned about
So Paul's concerned, and I get this, that so much money is in private credit, and they're doing so many deals that banks could have done, and it looks like shadow banking, but there's not the kind of regulation that may be necessary. Are you worried about that as well?
Look, I do think private credit has a space. There's a reason for it. There are certain companies, certain assets that don't get banked by the banking sector, and there's a reason for private credit. Our issue, and the reason that we think differently about private credit, is that it's highly correlated with stocks, right? If you look at it, I think people think they're getting diversification by having a portfolio of stocks, a portfolio of private credit, and those are totally different. The problem is they behave very similarly. You don't really have, in a lot of cases, the equity cushion that you think you have. So we go through another 2008, I think you're going to be in trouble in both. And I think the facade of diversification is what's scary to me about private credit.
One of the areas that I thought was off the beaten path, alternative was securitizing music royalties. And then, boy, that exploded. And now every 70 to 80-year-old rocker is cashing out. Was that an area that you looked at, and what are some other areas that you think are kind of alternative to in the alternative space?
Yeah, it's a really, really good question, and you're exactly right. The ethos, our entire sort of raison d'etre of being at Cordillera is to find things early, and then sometimes the rest of the world finds it. We have to move on, and music and music publishing is a really, really good example of that. So we started investing in that space in 2015. We exited 2019 really as the same thing. As it was said, as the world finds things and they bid up pricing, the ex-ante expected returns are just lower. And so we try to move on when the world finds them. There are other things. I mean, litigation finance is another good example of those, right? Where we were early to that. We were able to get some decent returns out of it, and then the world found it, and we've kind of moved on. And so that's part of what we do at Cordillera. We are finding new things. Some things we're moving on.
All right, I got to call BS on this one. Whiskey barrels?
I was just going to ask about that, and I hadn't even seen the notes. No, I do see the notes. But, yeah, whiskey, I mean, I think that's legit. Wine, yeah, I have a friend who is now, he was on the street in a regular job at like Mother Merrill, and now he's doing wine as an alternative investment. Really? And they do the storage of it and stuff. But I think it's really interesting. I just had David Duncan on my television show today from Silver Oak. If you want a good bottle of wine.
Nice. Yep. Look, we love the whiskey. We've been doing and investing in whiskey for 4 years. We do not do the branded side. So we're not out there trying to predict what the next brand is going to be. We really own the feedstock to the brand. So we own the barrels of whiskey. The interesting thing about whiskey that's different than most spirits is that it has to be aged, right? When you first distill whiskey, it looks like vodka. It's clear. What imparts the flavor is the thyme and the wood. And so we really buy new fill whiskey, we age it for 4 years, and then we sell it back to the brands.
Wait a second. So like Pappy Van Winkle, right?
Yep.
Which is delicious bourbon.
Yeah, it is delicious.
Do they not put all their own bourbon into their own barrels and then hold it and then sell it to me themselves? Or
Great question.
Yeah.
So there are some, Pappy, which is distilled at Buffalo Trace, that actually distill themselves. The big vertically integrated Jim Beam, Jack Daniels that you know of, they do everything.
Yeah.
Most of the craft brand space that you look at, most of what you've drank on the shelf, Bullet, Templeton, High West, those are the industry has totally changed, and there are what are called white label contract distillers that they distill it. We age it, and then we sell it to the brands who use that contract distilled juice.
I did not know that.
There's so many things I don't know.
And I've been a pretty big drinker of Bullet for the
paying
past
attention to this
decade.
Bullet now has their own distillery.
I also like Colonel Taylor, just for the record.
As we get on there.
Yeah.
What's something that you guys are looking at that hasn't been discovered yet? Like, what do you think you're going to be early on? What's the next thing that? I mean, you don't have to tell us like exactly what it is, but just kind of like I don't know. You had boat marinas on there. I don't know.
Yeah. We're doing a lot of things right now in and around sports. So obviously sports have been discovered in owning franchises, but monetizing media rights around sports. Another interesting thing is income share agreements. So the idea that you might be able to loan a student or an athlete some amount of money in return for some share of their future earnings. And it's a space that we think is really interesting in the student space as an alternative to student loans. So instead of, hey, you owe $500,000 when you graduate from college, hey, why don't I give you enough capital for your education and then you owe me some percentage of your income over time. Same with an athlete. If you're in the NFL, what if I lent you $5 million? I think you're going to make $50 million over the course of your career, and in return, we'll get 5%, 10% of your
How do you
earnings.
Distribute that product or service?
Yeah,
how do you identify the student or the athlete? The athlete's, I guess, easy, but
you've just hit on the reason why we haven't done it yet, right?
Okay.
We think it's a great space. Everything we invest in, we need a management team and an operating team. And in this space, the income share agreement space, it is tough to find the right operating team. There's two pieces to this. There is a quant piece. You have to be able to predict what a group of people will make in their career. That's a quantitative problem. Then there's a human aspect to this, which is then how do you get in front of them, and if in the sports side, an agent, a business manager, et cetera, to talk to them about this deal. And so you kind of need to put both of those together, and that's a challenge.
And then you syndicate that?
Well, in the version of what we would do, our fund would be the one funding that.
Interesting.
Fascinating stuff.
Yeah.
Yeah. So much for just better than selling stocks and bonds all day. This is interesting. Chris Heller, thanks so much for joining us. Chris Heller is the co-founder of Cordillera. The
two L's together make a Y.
I got a 5 on my AP Spanish test.
Okay, well, I'm married to a Spaniard.
Yeah, I'm married. You can't speak a lick after that. That's but one of the many things wrong with our country. So, Chris, thanks so much for joining here. Talking about the alternative investment space, so lots of opportunities there.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's talk economics. Let's talk the labor market. One of the numbers that I wasn't really into until a few years ago is this whole JOLTS thing. And I go back and I look at the JOLTS, the job openings. And if you go back and do it on a max time frame, over the last 20 years, the JOLTS has been 4.5, 5 million job openings. We're at 9.5 right now. And obviously, in the beginning of the pandemic, it peaked at about 12. But my question is, who are these people and how come they're not working? I don't get it. Nikki Hancock, maybe she can help us out here. She's a managing director at AMS. Nikki, thanks so much for joining us here. Give us a snapshot of kind of what you're seeing out there in the labor market. Yeah. We hear from a lot of companies that they can't find the people they want.
Yeah, and first of all, thank you for inviting me. But you're absolutely right. I think when we think about the labour market, I think we just have to recognise the volatility that we've seen over the last 3 years and some of the complexity that goes with the labour market, whether that be from the immediate environment and economic environment that we see ourselves in, or some of the macro trends regarding, workforce participation rates reducing, overall people going into the workforce reducing. And so what you hear is there absolutely still are roles and skills that organisations are finding challenging to hire to. And some of that is because there is a skills gap. So organisations need certain skills and there's just not the availability of talent in the workforce. And some of that is just a reflection of, a more cautious outlook for some organisations. Obviously, we have seen some layoffs this year, but we're also seeing employees stay longer as well. If you think about the Great Resignation that we were all talking about 12, 18 months ago, and we see the shift there. So there's a lot of factors that are impacting the labour market.
Is that a sign? I mean, the fact that employees are staying longer, and I've heard from a lot of employers that they're hoping for a little more attrition, but nobody's leaving. Is that a sign that the job market, that the labor market is getting weaker?
I think it's a sign of lots of different things. I think when you hear organizations say that, no one's leaving, I think one of the challenges organization has is the skills that they need within their organization is changing so much. So if you think about probably about a third of jobs will need completely different skills over the next 10 years. And so I think the challenge for organizations is with this level of change that we're seeing, how do we get those skills in our organizations, whether that's with existing employees, because maybe attrition, is less than it was, or when we think about hiring talent into an organization, how do we think about those skills that we need? And I think that just highlights some of the complexity around the labor market.
So you have in your notes, companies will start hiring people, not resumes. What do you mean by that?
I think what we've seen is a real shift because of this volatility and some of the challenges to what we would describe as skills-based hiring or skills-based mobility. Organizations and the job market typically is built on looking at education and experience. And what we're seeing is organizations and progressive organizations really want to think about skills, whether that be technical skills or soft skills, and how they can think about that when they hire in talent into their organization, or where they think about how do they maximize talent within their organization to help sure that they're widening the pool. So where there are skills gaps, they can think about that more creatively. But also to think about how do they get the most from the skills within their organization versus just looking at education and experience.
What are the most important kinds of experiences you want people to have? I mean, is this like backpacking around Europe or, starting up coding, a computer a repair business? What are we talking about here?
Yeah, I think the big shift because of the last 3 years is organizations and employers are looking for some of the soft skills around problem solving, ability to cope with change, around kind of leadership, because organizations need to be more agile. We all know what we've experienced the last 3 years. And, clearly there's a lot going on in the world at the moment and a lot of uncertainty. So it's some of those softer skills that they're looking for. But also, if you think about technical skills, especially in areas like tech, they're changing. And organizations it's not consistent for organizations or sustainable to think about, laying off people with the wrong skills and then trying to hire people with the right skills when those skills aren't always available. So I think from a technical skills perspective, recognizing they will continue to change as an organization and an employer, what can we do to help reskill and upskill our employees?
Nikki, where do you think we are these days, and maybe just from your talking to your clients, with the kind of where are these folks going to work? Are they going to work from home, work from the office, hybrid? How flexible do we need to be? Is that changing? Are we ever going back to 5 days a week? Kind of where are we in that spectrum these days?
I think certainly from the clients that I speak to, that is still an ongoing discussion. I think what we can see is we went through a period of everyone working remotely. And if you just look at the number of job postings, a significant number would be remote. What you can see now is there is a much more of a shift towards hybrid working versus remote working. And I think it does depend in terms of industry and geography as well. When you think about that, some industries have been very focused on getting their employees back to the office, like banking and financial services as an example, whereas others, professional services as an example, have been much more flexible. But I think it's definitely still an ongoing discussion and debate, and I'm sure employers and employees will still be, having clear views on that.
All right, Nikki, thank you so much for joining us. Really appreciate getting some of your time. Nikki Hancock, Managing Director at AMS.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Matt Miller and Paul Sweeney in the studio for Carol and Tim, who are on vacation somewhere. Sure. But we're happy to be here, and we have a great guest, Vuong, here in the studio with us. He is currently a CEO of Garrison Fathom. He was the CEO before that of Fathom Holdings and participated in some public-private partnerships, and also was a bidder in an auction for Remington Arms Company at a pretty young age. Cool. After he played football at Penn State and did his MBA at Harvard. So he knows a thing or two about finance. Vinh, thanks for coming in the studio. We just saw the end, I think, for now, of the trial of Sam Bankman-Fried after his crypto empire collapsed. And you actually met Sam Bankman-Fried. He was looking for investors and talked to you. You've met a number of the biggest players in crypto. Although you're a skeptic, they still let you in. What do you think about how this trial ended up and what we're going to see next?
I think the trial is, in my opinion, fantastic. I think it actually finally exposed crypto for what it is, which is a Ponzi scheme. I've said that for many years now, and I continue to think that way. I think what's going to lead now is finally the law enforcement and, for example, like the DOJ is finally now aware of what's happening in the crypto space, better knowledge. And I think it's going to really bring up a lot more trials and cases like SBF. I think that's just the tip of the iceberg. I think because he was the biggest name out there, and that's going to raise a lot of red flags and put a lot of pressure on DOJ to find more. Because I've said it before, I mean, a lot of these crypto projects, they're all practically Ponzi schemes.
All right, why do you say, that's a strong statement, why do you say Ponzi scheme?
It is, I feel like we need to push back on that one a little bit, like legally.
Well, so
and it's such a broad array of some are businesses, some are simply blockchains. Why do you say that?
Well, I say that because we've had so many of these meetings with a lot of these leaders, right, in the crypto projects. If you look at the fundamentals of what they are, all they're doing is literally moving money from one investor to another behind the scenes. They're not providing any real value. Now, I give blockchain a little bit of credit, like Ethereum. They are providing a utility to host a lot of these projects, a lot of these tokens. But other than that, it's a barbaric system. I mean, if you look at it, they push for innovation, they push for moving forward, decentralization. But if you look at that, it's pushing us back centuries. I mean, it's a barbaric system. It's a barter system.
How is it pushing us back centuries? How is that?
Because if you look at each of these projects and what they're doing with the tokens, they are practically creating make-up tokens, right? Which is not backed with anything other than hyped-up marketing. And they're trading with one another and bartering one another. So it's taking us back in time just with modern technology and bartering. That's all really what it is.
So, but you're talking about also when you say moving cash from one investor to another, kind of the commingling of funds that looks like we saw at FTX. Do you think the same thing is happening at other big crypto exchanges like Binance, like Coinbase?
Oh, most of them, yeah, absolutely. Binance, Coinbase, they all are doing that. Now, if you look at how these exchanges function, right?
Because I would say if Brian Armstrong were here, he would say we are not doing that.
Oh, I would love to talk to Brian more about this. I mean, if you look at the fundamentals of what Binance and Coinbase do, the reason why they have a little bit leeway is because all they're doing is they're harboring a lot of these, again, Ponzi scheme type projects. Unlike NASDAQ and the New York Stock Exchange, right, they actually do really intense audits and intense reviews of all the businesses that they that they host and they exchange, right? If you look at Binance, you look at Coinbase and these guys, it's not very, very in-depth. And a lot of these tokens that are on there, or these crypto companies or businesses, whatever you want to call them, there's not much there. They're not actual business.
It does seem like Binance, because they are listed on SEC filings as, you know, surveillance partners for some of these ETFs, for example.
Right.
It does seem like Coinbase is a little bit more trusted and a lot more transparent than Binance or FTX.
I mean, I think so. I mean, if you look at their transparency, they're doing what the minimum is for SEC to make them happy. But if you look at their filings, they're so delayed and it's so very generic. You look at the actual underlying filings, there's so many questions from the SEC. But real quick, I just want to take another real quick step back on why this does not work, right? The decentralization, what crypto is doing. If you look at how they operate, it's really ideal for money laundering and crime because it's so complex. The reason why we have such a great system currently now, yes, it's a little bit, you know, there's some little abuse in our traditional system.
I was going to say, don't you think the U.S. dollar is pretty ideal for money laundering? I mean, if you had to guess a percentage of currency used in crimes, don't you think the dollar would have like a very high percentage?
Yeah, but that's just, if you look at that, that's just the dollar from a traditional standpoint. But if you look at what crypto is doing, they're just, a lot of these founders tell me they're like the dollar. All they're doing is making it more innovative and more efficient and more transparent.
But it's also very trackable. I mean, I think about Bitcoin mostly. Right? I think mostly about Bitcoin.
Yeah, but real quick, Venmo, if you look at bank accounts, you look at banking transactions, it's all there. If you look at how these ledgers work with crypto, it's not really that transparent. All of this is a bunch of numbers and when the transaction happened.
But there's no way for me to put a bunch of Bitcoin into a duffel bag and give it to you, right? I can do that with dollars.
It's practically the same.
But Bitcoin's still on the blockchain. I can see where it goes.
Yeah, but it's practically the same because all this is a bunch of ledgers. I mean, all of us right here can have 10 different ledgers, right? And I can put 1 billion Bitcoin into one ledger and then just go away. That's practically a duffel bag. That ledger is a duffel bag. And the thing is, there's so many of these crypto projects. It's so complex. They keep trying to say they're trying to help regular people, but they're not because all they do is make it more complex. What we truly need to do is actually focus on real financial innovation. There has been true financial innovation of a product. I'm not saying technology and using electronic, like being able to Venmo or use Robinhood to trade. I'm talking about product innovation like ETFs, right, which was created in 1993. What we truly need is new innovations that continue to advance finance and society forward. And I'm happy to say we're doing that. We're going to be launching this here real soon, which we'll announce later. But that's what we need, not crypto. Crypto is just harboring more crime. It's harboring more complex ways of trying to be cool and all those sorts of things, but it doesn't really provide any value.
All right, good stuff. Vinh, thanks so much for joining us. Vinh Vuong, he is the CEO of Garrison, Fathom, and Vuong Holdings. Talk a little bit about crypto. I'm going to call it out, Matt, because it trades all the time. Bitcoin, it is up 1.4% here today, $505, or trading at 35,535. So it continues to hold above that 30,000 level. But of course, a lot of volatility there on the Bitcoiners. You know, I call it that because Tom Keene doesn't really want to talk too much.
BitDog, he calls it.
I know that's not very nice.
But it's still trading for 35 times more than it was when I first started covering it.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Yeah, Carol and Tim's show has great music.
It does.
I mean, just
The best music.
classic.
I'll
It's a lot of
shout
fun.
out to their producer, Paul Brennan.
Who?
Paul Brennan.
Never heard of him.
he and Ariel Agami typically put together like a slammin' playlist for every single day. And it's a 3-hour show, so it's like a lot.
Exactly. All right, we're driving to the close. Hey, Matt, it's not Friday, but we have a little treat for you today. We can talk municipal bonds again here.
Great.
Yeah, we got Nick Venditti joining us here. He's a senior fixed income portfolio manager at Allspring Global Advisors. I knew them back in the day before the Allspring name came from somewhere.
Nick, Margie Patel shot, right?
What's that?
Margie Patel.
Oh, Strong Funds is mine.
That's right.
I go back to Strong Funds. Dick Strong, back in the day. Those guys would buy anything I brought through town. It was great. I love them. And then they'd toss it out if they didn't like it after 15 minutes. But that's okay. Nick Venditti joins us here in our Bloomberg Interactive Brokers studio here. Hey, Nick, what are we doing in the municipal bond market these days? We had such a run-up in rates. And now, like Matt and I are having a conversation, have we seen peak rates here? I don't know what's going on. What's been happening in the municipal bond market this year?
Volatility.
Okay.
Look, I think rates are interesting, obviously, on a day-to-day basis. They move 15 basis points up or down. No more, no less. It's just crazy. And obviously that's been driven by Fed interaction, but it's also been driven by the Federal Reserve members showing up on programs like yours and saying the crazy things that they're wont to say from time to time, which is just as impactful to markets. I do think that we are probably seeing a crest in rates. They hit 5% on the 10-year and retreated back. Maybe they go a little bit higher for points in time, but ultimately I think we've seen the peak.
And so you also think we've seen peak inflation. I mean, not just peak inflation, but you think inflation is on a downward trajectory towards the Fed's 2% target?
I do. 2% may be kind of pie in the sky, right? We still have a long way to go.
That's headline PCE, by the way. Oh, that's what they got to hit. That's right.
Yeah, that seems like a tough road to manage, especially when we're, at least partially funding a couple of wars and obviously everything else that's taking place in the economy. But clearly, inflation is on the way down, right? Restrictive policy is working. We're starting to see some softening in employment numbers, those types of things, which I think indicate pretty strongly we're going to get a turnover in the economy.
I mean, this is a good time for me then to ask what you think about the deficit spending, the debt, which is one of those things that like grinds my gears. But I see, since you studied applied economics at the vaunted University of North Carolina, at UNC, you must know what you're talking about. Then
there's such smart people over there.
Yeah. then what do you think? Does it matter to the bond market if we spend like $2 trillion more than we have every year?
At times it does, and at times we can somehow ignore those realities. Look, I think ultimately the lesson we're going to start learning very quickly, especially at these higher rates, is that from the smallest municipality all the way up to the federal government, we are a debt-financed society. And that debt is getting more and more and more expensive with potentially fewer and fewer buyers. And ultimately, I think our uppance will come as it relates to that math, but we're not quite there yet.
All right, in your notes, you've got something that grabbed my attention. Muni bond investors may be more tuned in to U.S. macro economy than anyone on Earth, and macro indicators are pointing toward a recession in 2024. Now, you've probably heard, because it's everybody's heard. I pulled my recession call off the table 4 or 5 months ago.
And he went to Duke.
And I went to Duke. And so, but you guys are still thinking that, right?
Yeah, I think we are absolutely going into a recession. No landing, no soft landing, whatever buzzword people are using to kind of decide what's going to happen. Look, the reality is if you look back over the last 18, 24 months or so, GDP has been driven by a single factor, consumption, right? And that consumption has largely been credit card financed. So you have credit card balances that are as high as they've ever been at rates that are frankly as high as they've ever been. The days of minimum payment USA are probably coming to an end. You pair that with a couple of other factors like student loan payments. Look, I have to remind people all the time that a lot of the people we deal with on a day-to-day basis, they're not real. They're not real people, right? Real people in this country don't make $100,000 a year. They make like 40. And if the average student loan payment for someone 25 to 40 years old is somewhere between $250 and $400 a month, you're talking about $5,000 a year. For someone who makes $40,000, $5,000 a year is everything. That's $5,000 that's no longer being spent on Cheetos and stickers and glitter, whatever it is people buy, but that's going to have a meaningful impact on consumption and GDP.
Well, that's no fun.
No. But I think, look, this is what we've been hearing this is what Torsten Slok has been telling us for months now. You know, people are spending more on credit cards. Those bills are getting higher and higher because rates are so high. Some would say usury. Car payments are getting missed. Food bills are higher as a percentage of your disposable income. I guess if it's disposable, a percentage of your income as they ever have been before. So it's going to be tough. How bad do you think it's going to be? Like what do we see in terms of unemployment, for example?
Yeah, I mean, look, I think the good news is that we're smarter than we have been in the past, theoretically. And so I'm not calling for grapes of wrath depression or anything. But ultimately, I think we could see unemployment rates tick up, 100 basis points from where they are. And relative to history, that's actually not that high. But relative to more recent history, that's a pretty big shock. And I think a pretty big shock, one, to the system, but also a pretty big shock psychologically to investors across all markets.
Don't you think that the government will try and do something about that? I mean, we are also headed into an election year. That seems pretty unacceptable to the Biden administration to me, unemployment at 5%.
It absolutely does, right? And so I think they will try to do whatever they can to mitigate that as many ways as they can. But you also
I was thinking about just spending more money. That seems to be the playbook, right?
Yeah. The problem with that is that is inflationary, right? And so you have this push-pull taking place, which is why, again, I think it's pretty difficult that the Fed is ever going to achieve their target, given that these two competing realities exist so strongly in the world today.
Have you had your first snowfall yet?
We have, yeah. See? Halloween, we got dumped on in
Menominee Falls,
Wisconsin.
Right?
That's right.
That's awesome. Again, here's my call again. Pound for pound, the smartest investors I've ever encountered are in Milwaukee.
Why is that?
I don't know.
I've heard you say that before, but
yeah, I mean, it's just all the strong people, the state pension fund, the really smart people, lots of little Nicholas, and I mean, lots of little funds in there, and there's even more now than when I was on the sell side. And something in the water out there. Maybe it's that University of Wisconsin thing. I don't know. But anyway,
this sounds right to me. Yeah. I feel pretty good about that call.
Exactly. Yeah. All right, Nick. Thanks so much, Nick Venditti, Senior Fixed Income Portfolio Manager, Allspring Global Investments in Menominee Falls, Wisconsin. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.